Welcome students. Today we will understand about the financial systems. The financial systems deals with the financial transactions and exchange of money between savers, investors, lenders and borrowers. Before understanding the concept of financial system, we must understand the what is finance. So finance is the study of how people allocate scarce resources over time. Decisions are made across time. Decisions are made in an environment of uncertainty. Decisions that are made in context of a financial system. Now we come to the point that what is financial system? It is a set of markets and other institution used for financial contracting and exchanging of assets and risk, market for stocks, bonds and other financial instruments. Financial intermediaries such as banks and financial insurance companies, the regulating bodies govern all these institutions. Financial system, as we know, are made of different, intricate and complex models that link financial institutions and markets to provide financial services for various stakeholders operating in financial system like depositors, lenders, borrowers, government and others. So we can say the financial system that is deals with the financial transactions and exchange of money between the savers, investors, lenders and borrowers. Now we must understand what the market is. Market is nothing but it is a venue where goods and services are exchanged. A financial market is a market in which people and entities can trade financial securities, commodities, and other items of values at low transaction cost at prices that reflect supply and demand. Securities include stocks, bonds, and commodities include precious metals and agriculture goods. Now we must understand the how important financial markets are for economic growth of a country. So, well functioning of financial markets facilitate the flow of capital from investors to users of the capital. It provides payment system for exchange of goods and services in the economy. Market provides savers with returns on their money saved or we can say invested, which provides them money in the future. Market provides users of capital with the necessary funds to finance their investment projects. It also facilitates the investors and other market participants to liquidate their investment alternatives like stocks and bonds. It provides financial capital for long-term capital formation for the government and business organization. It provides the mechanism to pull the funds in terms of household savings for corporate investment. It provides the avenues for managing the risk faced by the market and participants. It takes care of both short term and long term needs of the market participant. It supplies the required financial capital to government for public expenditure on social welfare activities, investment development and many more. Well, function, well functioning markets promote economic growth. We can say economies with well developed market perform better than economies with poor functioning markets. It provides the price formation information which helps to coordinate decentralized decision making process in various sectors. It helps in reduction of asymmetric information and moral hazard problems, which in turn facilitate in reducing the transaction cost. It creates different investment opportunities for investors to maximize their returns. And also we can say it provides the price information that helps to coordinate the decentralized decision making process in the various sectors. It helps in efficient allocation of financial resources. It plays a significant role for economic growth as it helps to create the demand and supply of funds through which interest rates are determined in various markets. Changes in interest rates affect money supply, inflation rate, and also possibility of foreign investment. Now we must understand the types of financial markets. There are several forms in the market, that physical assets versus financial asset, money market versus capital market. As we know, money market is related to short term investments and capital market is related with long term investment. Primary versus secondary market, spot versus future market, public versus private banks, derivative versus future and options market, foreign exchange where we deals with the currencies. We convert the currencies in foreign markets. So types of market in detail, if we study the particular markets, then we come to the money market part. In money market, as we know, it refers to short term needs. So where the borrowers and lenders exchange short term funds to solve their liquidity needs, means the time period, the time spent is very less in money market. This is the conventional distinction based on differences in the period of maturity of financial assets issued in these markets. While the money market deals in short term claims with a period of maturity of 1 year or less, the capital market does so in long term. So, how we classify these? By the maturity period. Maturity period above 1 year in capital market. Now we move to capital market. Capital market is a market for financial investments. Mark my word, it is for investment. And in a money market, what we were doing is we were like we were solving our liquidity needs. In capital market, we are doing investments. It is a wider than security markets and embraces all forms of lending and borrowing, whether or not advocated by creation of negotiable financial instruments. Types of market. Securities market. The securities market, however, refers to the market for those financial instruments, claims, obligations that are commonly and readily transferable by sale. The security markets has two independent and inseparable segments, that issue primary market and stock market. Now we come to the part, the primary market and the secondary market. Primary markets deals in the financial claims or new securities, while secondary markets deal in securities already issued or existing, or we can say outstanding. Primary market provides the channel for sale of new securities. The issuer of securities sell the securities in the primary market to raise funds for investment or to discharge some obligation. Secondary market deals in securities previously issued. They are already listed securities. This secondary market enables those who hold securities to adjust their holdings in response to changes in their assessment of risk and return. They also sell securities for cash to meet their liquidity needs. The secondary market has further two components. Spot market. In a spot market where securities are traded for immediate delivery and payment. Forward market. The other is forward market, we can say, where these securities are traded for future delivery and payment. Means the delivery will be on a future date. The forward market is further divided into futures and options market. We can say in a term derivative markets. With this, I would like to thank all of you. Thank you. Happy learning.